Hey everyone, it's Abaroa with Financial Intelligence Training. It's Friday, it's May 18th, it's 2018, and tomorrow, for all you horse fans, we have the Preakness. And just so that you know, yes, I'm pulling for Justify to win. I tweeted out yesterday that I'm hoping he wins because I'd love to see the excitement of the Triple Crown. Plus, man, does it make the Belmont so much more exciting when there's actually a running there, right? Now, I've had a very busy week on the road. I was in Washington, D.C. on Tuesday, Minneapolis on Wednesday, Chicago on Thursday, and I'm finally back here in Fort Lauderdale. A terrific day on Wednesday, by the way, at the Allianz campus. Great information from the hedging panel. Amazing the challenges that are presented with interest rates when pricing for product. You know, I talk about this because the more you understand from that side of the business, the better that you can interpret which tools are right for your financial plan. I talk a lot about that in our financial intelligence training course. So let me, by the way, correct a verbal typo. Yeah, a verbal typo that I had from my Wednesday post. It was early, I was in the hotel room heading over to the campus, and I accidentally said, when talking about rates, I said the 3-year in regards to rates, but what I meant to say was the 3-month bill. So if that caused any confusion, I certainly apologize there. So let's dive into the markets. Oil continues to rip higher and rates are pressing on that 3% mark. They continue to hover above it. So it's completely relevant for us to monitor. Why? Well, if you're watching this video, then you probably have a car. Maybe you live in a house, right? Maybe you have some kind of credit card debt. And if you live in that house, maybe you've got a mortgage. Well, putting gas in your car and paying for housing or debt gets more expensive as the aforementioned rise. And yes, that's an obvious statement, and you don't need me to tell you that, but the takeaway is that that starts to hinder our economic expansion. And I've mentioned that we've already seen some contraction already coming into play in the macros. So these external pressures, well, guess what? They're not going to help change that. In fact, they could actually hurt that more. So on the subject of macros, the disconnect between hard data and survey data remains. Working against the macros is productivity. And speaking with some of the portfolio managers, they suggest that GDP figures are going to live within that 3% range, which would ultimately cap any forward interest rate hikes that we might see. Fed funds, I think, are being priced in at about a 45% chance that we see 3 more hikes before the end of the year. So we're going to have to really carefully monitor that and the implications to the markets and any recessionary pressures that may follow suit thereafter. Now, the flip side to all this is in the Russell. Yep, that's right, the Russell. Somewhat relevant in the world, right? I mean, it is 2,000 stocks after all. Well, guess who's making new highs? You got it, Rusty is. Yesterday, we saw the index break out of its January high, while the Dow remains about 1,900 points from reaching its high, and the S&P needs about 150 handles to get back to glory. So we can say this is a bad thing? No, not. In fact, the opposite. If small caps are leading the way, then typically, to me, I believe that means the big money isn't leery of the party ending anytime soon. All in all, though, we remain in this range-bound purgatory theme that I've been talking about here if you've been watching the channel. The key support levels held, additional areas of the market are now really starting to show signs of recuperation, and that's what you want to see from a bullish perspective. In the financial intelligence training class, we talk about learning all of the different tools that you have available to you and to your financial plan. I currently, right now, don't see real panic in the markets, but that doesn't mean that you should become complacent. So I encourage you to use all this recent volatility to assess your holdings. How, if further risk had prevailed, what your portfolio would have looked like and what impact that would have had on your financial plan. So, speaking of all the volatility, if you're trading, I'd like you to keep in mind that stock and stock options involve a substantial degree of risk and they're not suitable for all investors. And if you're watching charts like I love to, remember guys, past performance is not necessarily indicative of future results. I'm Abaroa. Thanks for watching. Everybody have a great weekend. And don't forget to watch the Preakness. Go Justify. Thank you.